we're going to learn what liquidity really means and how to identify it directly on your trading chart. Liquidity is not just a trading term, it's the foundation of how price moves in every market. By the end of this video, you'll understand why price targets certain zones and how professionals use liquidity to their advantage. Scene 2. What is liquidity? Liquidity simply means how easily an asset can be bought or sold without causing a big change in price. In highly liquid markets, like Nifty, Bank Nifty, or major forex pairs, orders are filled quickly because there are plenty of buyers and sellers. In low liquidity markets, price moves sharply even with small orders. On your chart, liquidity represents areas where orders are waiting. These are usually clusters of stop losses, pending buy or sell orders, or consolidation zones. Text on screen: liquidity equals pool of orders waiting to be triggered. Scene 3. Liquidity zones on chart. Let's see how liquidity appears on the chart. The most common form is equal highs or equal lows, when the price touches the same level multiple times and forms a flat line. Traders place their stop losses just above or below these levels. As a result, these zones become pockets of liquidity. Smart money and institutions know this, so they push price toward these levels to fill their large orders. Text on screen: equal highs equals buy side liquidity, equal lows equals sell side liquidity. Scene 4. How price hunts liquidity. Now watch how price behaves near liquidity. When price moves up and breaks above previous equal highs, many traders think a breakout has started. But often, it's not a breakout, it's a liquidity grab. The market triggers all the stop-loss orders sitting above the highs, collects liquidity, and then reverses direction. The same thing happens below equal lows. This pattern is sometimes called a stop hunt or liquidity sweep. Text on screen: price moves toward liquidity, collects it, then reverses. Scene 5. Institutional perspective. Institutions and smart money traders use liquidity to enter or exit large positions. They cannot place huge orders randomly because it would move the market instantly. So, they wait for price to move into liquidity pools where there's enough volume to fill their positions. When price reaches a liquidity area, institutions execute their trades quietly, and that's often when retail traders get trapped on the wrong side. Visual suggestion: show a chart where a liquidity grab happens followed by a big reversal candle. Scene 6. Identifying liquidity on real charts. Here's how you can identify liquidity zones on your chart. Look for areas where price has reacted multiple times. These are likely liquidity zones. Mark equal highs or equal lows. Liquidity tends to build there. Pay attention to consolidations before strong moves. That's where liquidity is being created. Watch what happens when price sweeps those levels. A sharp reversal usually confirms a liquidity grab. Text on screen: liquidity builds, gets taken, and then the market moves in the real direction. Scene 7. Example breakdown. Let's take an example. Imagine the market forms 3 equal highs at the same level. Traders place sell positions below and stop losses above the highs. Price suddenly spikes up, breaks the highs, hits the stop losses, and then drops sharply. That spike is the liquidity grab, a clear sign of smart money in action. Now you know where the real move begins, after liquidity is collected. Text on screen: liquidity grab equals smart money entry zone. Scene 8. Conclusion and call to action. Liquidity is the heartbeat of the market. Price always seeks liquidity before it moves in a new direction. Learn to identify these areas, and you'll start seeing the market from the perspective of institutions. If you found this video helpful, hit like, share it with your trading friends, and subscribe to Chart Matrix for more trading insights every week. See you in the next one. Trade smart and stay patient.